Hi traders, and welcome to a new video. Today we're gonna take a look at the treasury bonds from the United States of America, and we're gonna take a look at how you could have made 100% at least with the last crashes who happened in the financial markets. The crony bankers from JP Morgan told us yesterday that they see the yield of the 10-year treasury bond, of the 10-year treasury up to 5%. But this is total fake, because when the bond goes up in value, the interest, the yield of the 10-year goes down. If the yield goes up, there is more risk, more unsecurity, in less trust that the next 10 years will be good for the United States. So if that yield goes up, the trust goes down. And JP Morgan says that yield will go up a lot because, as I show you, that yield is at nearly 3%, and JP Morgan says it will go to 5, but it will not go to 5, and it makes the opposite of the bond. I will show you also this later. But what we have to keep in mind is that this will not reach the 5%, in my opinion, because we have a downtrend here. Yes, it's a bit an uptrend also, but we have a channel here, and that channel will, in my opinion, not be broken on the top. Why? Because here we have a so-called divergence. The yield goes up, but the momentum indicator of the last 3 weeks goes down, and this is from February on. So I think we're gonna go lower, much lower. We're gonna see maybe this low from September 2017, and I will show you in the yield what this means. This means that we could trigger again the totally crazy 2%. This will mean, to be honest, that the US stock market will go through the roof, even if I am a bit permanent pessimistic on that whole system. If the 10-year yield really goes down, so then the institutionals, they really see much less risk the next 10 years for lending their money to the US than now. So keep this in mind, please. If this line gonna break, we will face 2% in yield, and this means totally crazy new all-time highs in the US stock market. And please bookmark yourself the link. I made it that you can see it from your home PC or phone or whatever, and bookmark it under US 10-year yield, and you make in also maybe new time highs that you could write ATH and then a point of interrogation. Let's continue with gold. As we know, the loser always tell us, not only the losers, it's a bit hard what I say, but every piece of shit that is too stupid to understand the stock market, but knows a little bit how they fiscally rape us, the government, I mean with they always tend to go all in gold. No matter what happens, gold cannot go to zero. Yes, that's sure, gold cannot go to zero, but gold can go to 700 or to 200 or to 400. It is only a hedge tool for avoiding pain in the stock market. And yes, before the Armageddon, it will be the only money that you can own without that the state can rob you in terms of purchase power. And yes, this day will come, but no one knows if it's tomorrow or in 10 years or in 50 years or in 100 years. We know socialism can't work, otherwise we would all be Russian already. But anyway, it can take decades before that whole system will go down, alright? And therefore, be also focused on the stock market. Not only because I say it, and not only because the fake news are all day telling that the crash will come, but because it's a tool. It's a tool of prosperity to take part in the global growth of 3% per year approximately. And what I want you to know is, until gold will not reach this level from also 99, until then you can get a lot of pain in your face, because every idiot who thinks, oh, we will go long here, yes, of course I am also part of those idiots, because I will also try with a mini position to go long here and place my stop something like $100 lower with so-called knockout papers. But what I put in there is so-called fuck you money. I can survive a loss if I go here long and it goes lower than here. I am a trader, and most people confuse trading with investment, and most people think, oh, I buy gold and then I am safe. No, you are safe only if the shit hits the fan. If not, you will lose in purchase power, as you see here. Not quite only a bit, alright? So keep in mind, please, also here bookmark this link and understand to really only buy if you have no gold and silver at all. Of course, buy now for, let's say, 5%. I'm not a financial advisor, it's only what I would suggest from my feelings, okay? I am not a financial advisor, I don't have the right for that. Everything what I do is document how I would and will handle this market with my own capital. This is the actual price divided by the 36-month closing price, the average closing price. And this gives me a mathematical chart that has nothing to do with the price chart. Of course, I need the price chart for my calculations, but I see so much more that other stupids will not see. Because like here we see we should be at the same level already, 200 and something, and we aren't. Why? Because there is some momentum of the so-called tankers, central banks, all kind of institutional crooks. They buy gold, and we have the proof, because this low is not here, is not that low. But now the question is, because I tell you something, if you want to hedge against the system is there to control the financial market, and the financial market has only one task to fulfill, and this task is to give you maximum pain in the shortest time possible. Alright? So the maximum pain point isn't reached for the retail idiots in gold. They will sell when it comes down to 200, 400. And I tell you something, I don't see it this low, because, like I said, this momentum is higher. But maybe there will be some kind of, oh, we don't know what happened, but a computer made an error and we have a flash crash for 2 or 3 seconds in the zone of 800, in this zone here. Alright, maybe even 700 and something. And there I would suggest that we will reach that low here, and there you can put a greater amount in percentage into that trading position, or even buy physically, because I don't think that you will get a lot under 700 physical gold in our lifetime. And before you now go in full retard mode like the retailers, this is the monthly chart with the 3-year momentum as I showed you. Now I show you the 60-day momentum, and we see we have a downtrend from January on. Of course, if you are a gold bug, you buy only when the shit hits the fan, so here at those lows you could buy. But to say, oh, gold will go up only because we had a low and now we reached that low, as I told you, I am also part of those idiots who will really try here at a so-called bottom edge to go long into gold, because I know maybe there are no sellers anymore, or more buyers here than sellers, and therefore, so keep in mind please that until that downtrend is not broken to a new top again, be careful with long positions. And as I told you, this is a so-called bottom edge, and here is a so-called top edge. Maybe I can even copy it. Okay, here we had a league of buyers, okay, and here also, and here also, and that means every time where we go lower here again, normally the third or fourth time it has to break up, and if it doesn't, it's a so-called fake rally. Why? Because the institutionals, they want to go long, all right, and they go here, and then we monkeys, we follow, and here they sell again, and then they put it a little bit up, and we go long again, and they fuck us again and again and again, and here we think, oh, it's an accumulation. Now the institutionals, they go long in the market, and then we think, okay, they're gonna put in their monies here and here to trade this box in hope of an uptrend breakout. But then this happens, and this is a so-called fake. It is a fake bull trap, or a bull trap, simply without fake, and they go lower again. But why they go lower again? Because they want higher prices. But why do they put the price lower if they want higher prices? And I explain you. If I have, as an institutional, I buy for, let's say, 5 billion gold, all right, against the US dollar. What I don't want is all those shitty pieces of retailers who sell their little $50 here, $2,000 there. You know, all those sells, they interrupt my flow towards 2000. And this is what you must understand. If there are a lot of retail traders still long in that market, if now we would say retailer, that's what I mean with the maximum pain moment, that isn't reached now, all right? Because now the retailers think, okay, they fucked us here, but now they go long. And yes, maybe they go long again, and maybe it will go over 30, 50, and then it will go back again. You see what I mean? So a last time that we go here, and then we go even lower under the 1200, and then let's just take a look where we will hit the next. So at 1125, you see, and this is what I mean. At some point there are no retail traders anymore in the market who want to go long and to want to sell the part. Therefore the institutionals try to kick the price as low as possible, to kick as much as stops possible from the retailers, and then gold will make a move up that we have never seen before, for my humble opinion. But until this downtrend isn't broken up, for pretty sure the shit will not hit the fan, and therefore in trading, be careful please. And when it comes to insurance against a stock crash or systematic crash, you don't look at the price if you buy an insurance for your house. Everything you want is to make sure that you will avoid the total loss. And yes, with gold you will avoid the total loss, but if you put more than, let's say, 20% of your money in gold, you are completely retarded, because that piece of metal will only blink at your home and it will not gain you money, it will not work for you in the meantime where you sleep. But if you buy a stock or an index with dividend champions and so on, you gain money in your sleep. And if you don't gain money in your sleep, you have to work the whole day for it. And Warren Buffett told that this, and it's one of the most important things to understand in a civilized society, that you can gain money while you are sleeping only by participating in the global growth. And let's take a look at the SPY. We see the uptrend from February 2016 is still broken, so we are a bit weak on the longs, but as I told you, if that yield really gonna go down, it will be up in this channel quite fast. So here also, until that low here is not broken down, I would not suggest to short the SPY. And the SPY, to remember, is the best 500 companies rated by Standard & Poor's, and you have them all for $283 today. Also, this kind of product will for sure go down. There is no buy and hold mentality, in my opinion, today anymore, because the losses can be huge. So it's crucial that you understand how to short the fucking hell out of that market if the time has come to do so. And what is most important, or more important, is that you learn when to absolutely not short the market, like now, per example. Let's take a look at Mosaic. It's a fertilizer company, and we see here the downtrend from 2011 is broken direction from the upside. My clients and students are already long, I am too, and we have those highs here in mind. As we see here, if we make a line, we have already this top clearly passed, and that would already be 53, and we are at 30 now. So MOS is the symbol ticker of Mosaic company, really stable, and I see that high here also be taken out, and this one, and then we would already be at 72 and 87. And then last but not least, I will have my last take profit in this zone here, what will be around 146. all right, and yes, we are at 21, and yes, this is my target from here now. As you see, it took maybe, yes, quite 10 years to go down. Maybe it will take 4 years to go up, because it will always, in a recession mode I speak, the hedge products will go faster up as they came down. And I explain you why. Because the normal stock market, the normal stocks, like let's take an Apple, there we go high step by step. But if we go down, like you saw at Facebook last week, we jump with a bungee. And sometimes even we have forgotten to put the bungee on. But here we have a so-called hedge product. It's a product that I take for hedging my SPY long, per example. I'll show you this really quick here. If I make SPY long here, and I go short Mosaic, I have made quite a lot of money, as you see, from the crisis on. Show you quick how much this is. Yes, you see 1460%, and even not no leverage. So if we speak from leverage, we have make between 100,000 and 2 million%. And you know, it sounds so ludicrous to say 100,000% or 1,000% or 1 million%. Therefore, I never make publicity with that, because all the crooks and liars in the market also tell you buy this 2,000% stock and all that crap. But I want that you understand how I get those targets. It's by mathematical approach of the 3-year momentum also, and then you understand that how those targets, how I reach them, that it's not a crystal ball or something like that. It's a probability measure with a high target rate. And as you see here also, the uptrend is broken down, so the SPY now goes lower than Mosaic. All right, therefore let's go back to the old chart. But only that you understand how you really can make a lot of money in financial markets. It only depends that you are a bit curious, that you try to find yourself the answers of, okay, how can I protect myself, and how can I make a lot of money if a crisis will come, and how will I make money in the meantime where the crisis will not come. And I hope I give you some approaches that show you how I, or where and why I see those opportunities. Food is a hedge product against stocks, and therefore I buy food stocks for preventing to face huge losses, as I showed you in the so-called spread trade with SPY and Mosaic. And therefore I see that this high here at the very maximum, and at that point I would short again Mosaic. You see, I'm not an investor when it comes to those companies, even if I will buy them for years. But I see it only as a trade. I don't see it like Organic Garage as an investment. Like Organic Garage, I don't give a shit about where that price is. I only see myself keeping this company, the parts that I own, forever, and giving them to my children. And this is investing, what I mean with Organic Garage. It has nothing to do with the trading approach here, even if my trades have a very long time horizon. Then let's move to XHB. This is the house building ETF from the United States. So if the house market goes well, we can go long in the XHB. But as you see here, the uptrend from 2010 is not so far away, in my humble opinion, to broke down, and therefore we have also here an opportunity to make more than 100%, even 200 and 300, if that uptrend will be broken. So then we go short, we make a stop on a little bit over the all-time high, and we're gonna make a take profit here at 12.30. But how can we say that the real estate market will go down? And I try to explain you how I see it. But before, let me show you something really important. One house today costs approximately 360,000, let's say, all right? We have it here, 363,000. That's the cost of an average home in the United States of America. Now let's look how many ounces of gold you need for buying a one-family home in the United States. As you see here, in the 1970s you needed around 300 ounces to buy a nice house, and then the market made it possible that you could buy for a third of the costs only a few years later. And then you see that the real estate market measured in gold goes up, so that you need more and more gold to buy a home. And here you see the mean. That with that is mean that from 1975 until 2015 the average home price was 290,000, let's say. Alright, if now here would be frozen 300,000, but this is only the ounces. So the average ounces of gold that you have needed from 75 until 2050 would be 290 ounces of gold for buying a house in the United States. And you see, this is quite stable, even if here we saw that it went ludicrous with gold compared in real estate, really reached an all-time high around 560. And then the dot-com crash happened, and then here you have the Lehman crash that happened. And always if a recession or a crash comes, gold is worth more, so you have to own less gold to buy a house than the year before when the recession wasn't there. Alright, okay, and here it went down, 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 and here you see the bottom from 1980. And this means, and no chart on the world will show you that, no indicator, no whatever. This is something you have to know. End of story. You have to know if a real estate price compared to gold reaches 100, go in real estate. Gold is far too expensive, let it say so. Alright? And my task for you is to calculate me this chart and make it in Excel with the SPY ETF. Alright, that we have also the SPY to housing ratio from 75 until 2016, and you can even make it until 2018, and also update this chart with the gold and the housing price. And as I showed you, the housing price, you find it at construction NRS PDF US price monthly, and here you have the average median and the average price of a single family home in the United States of America. So burn you this chart in your mind, please, and always realize when gold is much too cheap and when it's much too expensive compared to real estate, please. And here we have the adjusted inflationary gold price. That means we don't have the high from $20 here, but this is what I mean. You know, imagine you buy it because any idiot told you, oh, the system will go down, and in the 80s we had nuclear wars in the really possible, it could be in a reality at that time. You see what I mean? And this you see also in the gold price, by the way. Also it has to do with Nixon, who put off the gold standard for continuing the war against the communists, what Russia has known way before even the Vietnam War started, how they could push the United States into a trap where they are obliged to take the gold standard of their money. But I don't want to only blame here the Russians. Both did horribly things, but without Russia there would be no Vietnam War. A lot of snowflakes don't know this, and it's pretty sad because United States only tried to save the South from being killed from the North, what unfortunately happened. Anyway, you see, you will suffer and suffer and suffer if you would buy in the 80s gold. But if you had bought a house here in the 80s, today you have the same amount that you need for buying that house. So when it comes to comparing gold to paper money, you see it's completely ludicrous, because here it's worth much less than here today. But if we compare it in houses, so in real product material goods, we see that we have today still the safety of the 80s, and here, while the price dropped down, it went up like crazy. And I hope you really understand. My approach is not a Keynesian one, it's an Austrian economical one. And I hope you will think also a little bit like me, but if you don't compare your gold investment with real material goods, but only with fiat money nominal prices, you will not get lucky. You will get maybe stomach cancer, because there is only pain for 30 years, and then it goes up, and then it seems, oh fuck, we're gonna hit the lows again, and possibly we will hit the lows again. No one knows. And then let's talk about those real estate son of bitches who try to tell you if you buy a home, it's a security. If you buy a home, then it's something that is there in hard times, that you can make to money. You can make a credit on it, a hypothetical credit. That means you resell the house to the bank, but the bank gives you a bit of money, and you can keep the house and pay that credit off. So a real estate agent would tell you, oh, here, buy, it's so secure, and look at this chart. If you have bought in 1985 at 170,000, today it has nearly doubled. And when we compare it to our gold, it's completely bullshit. A real estate object is still 200 ounces worth of gold, or maybe today 300, but you know what I mean. We always are around the average for the most amount of time. And please keep that in mind, how they also try to put you into the trap of buying a real estate. Look at those price differences, please. Compared in paper money, oh, huge deal, and then, oh, I lost nearly half again from 2003 to 2011. And when we come to gold, we see indeed this was really huge. But here we buy the fucking hell out of real estate again, you see. But this chart only goes to 2015, and we are again around 300 today. And if you want, you can do that chart for yourself. And learning the approach of comparing physical goods with physical goods. So gold with what can I buy? How many cars from what type today? And a car is a bit tricky, but compare it in Big Macs. There is the Big Mac index. Or compare it in real estate objects. You see what I mean. Then let me explain why I think that the XHB will go down again, and then that we will face new lows and make 300% on the short side. We have the S&P Case-Shiller Price Home Index, and as I told you, in May 2011 this price is much higher, 2011, and here we were at 2006, so it's higher. than before the crisis, but the average person gains much less compared to this time. Then comes the millennials don't buy homes anymore like the old generations did. Okay, but why does the price goes higher if no one buys a house? And I will show you. It's not that no one buys a house, but the bank gives it away nearly for free. And if you would lend $100,000, let's say, for a house here, you have to get at least 50%, 50% more safeties for the bank that they lend you credit. So if you lend from here on, you need 50% less guarantees that you can pay that credit off. So what you see here is the chart of real estate credits that the bank have given to the people in United States. And here we have the chart of the risk that the bank owns for giving that credit away. Let's say you make a credit in the bank for your house. Then the bank will ask you some safeties, even if it's much less than years before, but they still need some safety. Why? Because there is a risk that you cannot pay that house off, and that house is worth much less than the amount of money that they have lent to you. So the bank gives a credit and has a risk. But here we see the amount of credits in real estate goes up, is at a new all-time high, but the risk that they have in their bank accounts for giving those credits away is at the low of the 1990s. So how can they give credits to customers but not have the risk of the customers not paying that money back? And here is the answer. The Federal Reserve, so the United States taxpayer, he is the one who is the security today for those credits. Okay? Not the banks take their own risk anymore. It's the United States taxpayer who takes that risk. Okay, and let's keep in mind those are the credits of people who make a credit for buying a home. And now this is the housing affordability index, so an index who shows us if families are still have still the possibility to buy a house. And here we see that we are at the peak of 2008. You see what I here, this peak, maybe we come into that, but this trend for me is broken down, and if here it will break down further, our XHB will go through the roof, because if no one buys a house anymore, all those companies in this ETF will go bankrupt, or at least get a lot of pain for some decades to come. Also with 3D printing houses in 24 hours for $3,000, all that stuff. We are in a sector like in the car sector, we don't know how it will look like in 10 years. But keep please in mind, this trend here is for me already broken and will broke even more. And this whole stock rally is at the moment led by the so-called FANG stocks, so Facebook, Apple, Amazon, Netflix and Google. But let's take a look at the internet ETF of the Nasdaq, and we see here also the uptrend from 2016 is on the way to be broken down. We are still over the important one, but we are on the way to breaking it down. And there also I have a target of 65 and a stop of nearly $50. Here also you see some 100% are possible to make. And you see the divergence between a higher going price chart and the lower going mathematically chart of 40 weeks. And now I show you how you could have shorted the fucking hell out of the market and made at least 100% per trade. Here we have the 3-year momentum, and I took Microsoft because Microsoft was the leading tech stock at that time. And you see, always when this uptrend was broken down, a recession came. The dot-com crash, the Lehman crash. By the way, the Lehman crash was in September, so we went short with this approach from June on, and we had ISM already under 50 from January on and all that stuff. Then, why I show you this? Because sometimes we make ourselves crazy with that the next recession will come or not. This has something to do with our brain. We have still the brain from, I don't want to make too much Darwinistic propaganda, but something is, in my opinion, true. That is, we have something in our brain that is the same that insects or animals have. It's a fear instinct. And that fear instinct is very strong and is always there to make sure that we survive and not make stupid things. And when you come to stock market and you are committed with your own money, you have those existential fears 24/7. And we have to try to keep sane by not transforming into an idiot that believes into politics or something like that. But like now we say, oh, there are trade wars and all that kind of shit, but Microsoft is still in an uptrend from 2009 on. Everything is fine. If Microsoft now will break this uptrend and then will go lower under the important one, then it will get really, really nasty. And I show you something here. This is at the dot-com crash. It went to 0.61 and here it went to 0.59. So why is there a lower low at the new crash? And will there be also a lower low at the crash will come any day? And I would say yes. And you have to keep in mind why. Because here we have not so much baby boomers who have to sell, and baby boomers are the people who are born after the Second World War. So after Second World War the people get prosper again, and then a baby boom went on in Europe and the Western world, and those are called the baby boomers, the generation of our parents approximately. I'm 35. If you also saw that you have parents around 60, 70, it's that generation what I mean. And that baby boomer generation, as the dot-com crash happened, they had still time to save again, and they knew, all right, it's a normal crash like always happens. We will keep the belly flat, but we will not sell into falling markets. We will still put money every month into our pension fund. And as you see, if you have time, you reach always, not always, but if you have a leading stock, I mean, a good company you lead, you have the opportunity of really getting at least your money back. But here also, this is why you have to take tech indexes or something like that, because then you are not broken down. You are pretty much up after 3 or 4 years. But here you see it took nearly 20 years to be only break even. So congratulations for this shitty trade. But Microsoft pays dividend, so if you are a multimillionaire, you don't give a shit where the price is. You, as an investor, you identify with the company. But Microsoft investors got lucky because Microsoft achieved to reinvent themselves. And I say they will get a danger to Apple any day. So Microsoft stockholders really got lucky here. But what I mean is there will be a new low and a lower low, because today there will be a lot more baby boomers who have to sell into falling markets because they don't have another 20 years or 10 years to wait and to pay still in their pension funds. They are already retired now. So the money that they still have in stocks, they will buy it, sell it if they need money to live. And that, therefore, the drop will be huge compared to the crash of Lehman or the crash of the dot-com bubble. But as I told you, we have it on our watch list, and here also bookmark please that link and watch it not every day but once a week if you want, and even once a month is okay, but once a week would be nice because you know in how short-term time we live today. And then you are ready to short the fucking hell out of Microsoft with a new low, what means that also here we will reach around $60 and even go lower, but at $60 you can take profit. But not now, only if that uptrend is broken down, then you buy 10% out of the money, put calls, and with a living time of 1 to 2 years, and you will see that the chances are great that you will make a lot of money with this speculation. This is the long-term 3-year momentum indicator. Now I show you the 10-day indicator, so really quick trend. And we have an uptrend from April this year on, March this year on, sorry. And here we can take a first try to short it if this uptrend will be broken down. And also here, bookmark it and watch this at least really once per week to get ready. Then here I show you Goldman Sachs, how with this approach of 200 weeks, what is approximately 4 years, you will see here the breaking of the uptrend. And as I told you, the crash was here in September, the 18th to be precise, so there is no cause, but here was the crash. And we would, with this approach, been short since February, what would be from around 200 to 51, so 400% we could have made with that. Why I show you the past? Because you don't know if I talk shit or not. Therefore I show you in the past proof examples of this mathematical approach that I use to not burn too much my fingers in the financial market. And now let's continue. As I said, this was the past, and here we have then the uptrend. Everything goes well for the banks again. We take the risk, they take the gains of the yields of the credit they give out, but Goldman Sachs is an investment company. But anyway, you see what I mean. ISM goes a little bit up and they speculate again on the long side and they make some money. So we have an uptrend from 2009 on again. 2030. Yeah, it was a bit tricky. Oh, what will happen? If you remember, it was the Greece European crisis bullshit. And then here we come with, oh, Hillary will get the new one, and oh, the shit will hit the fan. But oh, for God's sake, Donald Trump won the election. So we went already into, oh my fucking God, another Obama will come, it will be worse than him. But Donald Trump got elected and Goldman Sachs get of the roof again. But now this party is over, and this is from May on, and you see again what is called, I call it, so I don't know if it's called like that, but I call it Mandelbrot pattern, because Benoit Mandelbrot, he was a guy that he saw things in the very little and in the very great, but they have exactly the main structure, like branches in a tree or veins in our body and all that stuff, or in the universe and all that. If you want, take a look at Mandelbrot fractals, and then you see what I mean. And these fractals, so what happens in the great and in the small scales, here it happens again. Here we have, for me, a so-called Mandelbrot pattern. It's a repetition of a fractal, so of something that comes always and always and always again. And you see here, we don't gonna make this trend up again. So be very careful with Goldman Sachs going long. But this is no financial advice, because if I say to short Goldman Sachs, they will put me into jail. So this is not the financial advice. It's only a documentation of my own craziness that I make. But anyway, keep in mind, in my madness, there are things who are gonna repeat themselves, and Goldman Sachs is ready to shit the fan. Then we come to Bitcoin, as we see here. By the way, we made a lot of money. Every one of my followers and students sold at 60,000, because I told everybody, if the 20,000 don't will last, it's fucking over. It's fucking over. Immediately, if the 20,000 comes, put a stop at 60,000, and they got triggered at that very week. And then it went up again, and oh, if it told us shit, and it will go up. But no, I didn't told shit, because you see here, the 40 weeks momentum showed us clearly, very clearly, that the party is over. Alright? And here also, again, the uptrend was broken down. A second punch in the belly of the Bitcoin, and then it went under the very important one, another hit in the face. Then it went over again, the one, and we went a little bit long, but we knew we are still in the downtrend. And here we saw, okay, again weakness, but now this downtrend from January on, it has broken to the upside, not so much, but you see it's at least sideways, and it's not going down again. So maybe we have a bottom, but as I told you, the financial markets are there to make us maximum pain. I don't think that we have a bottom already. But for a small position, of course, like in gold, the one who don't owns any crypto today is a total retard in my mind, because no one knows if one Bitcoin is really gonna have the price one day of 20 million Bitcoins divided by all the dollars. You see what I mean? All the dollars divided by 20 million Bitcoins. Maybe this will be the nominal price of Bitcoin one day. And we see at the top, it goes down again. Here, same thing, it goes down again. And if it's the same thing here now, then we have targets from 360,000 at least, or 1 million. I really don't know, because if there is no resistance anymore, no top that gonna pull down, then it can explode again. And as I told you, I think that before Bitcoin will go up again a lot, the stock market has to come down, and then the Federal Reserve has to stop to raising rates, and then the dollar has to die. And if the dollar index is under 70, then the dollar is dead, and then is maybe the hour for Bitcoin who will come. But I would prefer physical gold and physical silver in 1 gram pieces, if I only have the choice of one of those stuff. But I have a lot of ETFs in Bitcoin, Ethereum, all that kind, for I think 5%. That's okay for me. 5% is an amount I can lose it to zero. It will hurt me, but it will not destroy me. Then here we have US oil. And with US oil, you have to know that Aramco is a company in Saudi Arabia that is the wealthiest company in the whole world. And now they take 2% of their money, of their company, and they go public. They make an IPO, what means you can buy their stock at Wall Street soon. I think in winter this year or next year, Aramco will have an IPO, so Aramco will go, you can buy a stock of it from next year on. So I explain you why the wealthiest company in the whole world will make an IPO. This is because if you are an oil company and you go public, you have to prove your oil reserves. Alright? So it's not like now that you say, yes, approximately we have 700 billion barrels of oil in our soil. You have to prove it with geoscans and drills and all that stuff. What will happen when Aramco will prove their oil reserves? Then the whole world will see, oh, they don't have billions of barrels of oils, they have trillions of barrels of oils. They have at least 5,000 times more oil than we estimated that they have. This means if you buy a stock at the IPO, you're gonna hold it, even if it would go down further. You don't have to give a shit about it, only to buy more until that news will reach the market that the oil reserves of Aramco are 5,000 times more than estimated. And then the whole company will get priced much more. 5,000 times more not, but a few hundred times for sure. And now you understand why they said, okay, 2% of this cash machine, we will give it to the retail idiots that they can buy a part of it. But then we come out with the real scans and the proof that we have 5,000 times more oil than everyone thinks that we have. And then Saudi Arabia will be, with great exception, the wealthiest nation in the whole world. And then forget shale oil. The normal oil drill from US company costs around, I think, $45 for producing a barrel of oil. Okay. In the Middle East, there are countries they pay between not even $1 and $3 for also producing a barrel of oil. So you understand how they will destroy the American companies who are not situated on the Arabian soil, but only in the oceans and around USA, and you see what I mean. So at that day where Aramco comes with the announcement that they have 5,000 times more oil than it was estimated, the whole shell oil industry, the fracking industry, is done, because the Saudis will keep the price of oil for the next, I say, 50 years between 65 and $45. And this is not enough for the shale industry to produce with benefits, so they have to move off this market. So oil itself, for me at the moment, you see it here, we have broken the uptrend from 2015 in the 3-month chart, and you see here in the 10-day chart that we have also broken this uptrend. And even if it will go higher again, in my opinion it's completely fake, because Aramco will need the price to kill their enemies between here and here. So wait a second please. So between 65 and 45, this is their area where they know if they can keep the price here, they will put a lot of enemies out of business. And believe me, I think they will keep the price in that box for decades to come. And also forget all that electromobility idiocracy, because until the Saudis have not sold their oil, no one will really have an electric car that will be in price terms better than a fuel-driven car. And the Saudis and the Yahudis from Israel and the United States, they are friends. So you have to keep in mind, if they want a regime change in Russia or Iran or maybe even Turkey, everything or all they have to do is push the price of oil even under $40. As I told you, they have $2 or $3 of production price and the rest is gain. So they can hurt the Iranians and the Russians a lot. And believe me or believe me not, I don't have a crystal ball, but I feel it that the common war against Iran, the regime change, it's not against Iranian people, it's for liberating them, like we went liberated from the Nazi scumbags here in Europe. When this war will not be fought with classical soldiers, but with the oil price. And therefore I think also, if the official war will start, oil will go up. Oil will always go up when a war is. But until that official war happens, the United States with Saudi Arabia will maybe try to push really down the price into 36 again. I can show you we reached already once those levels. And there Russia and Iran, they really went into deep trouble at that time economically, and maybe it will come again. So the low here of 42 will come, and we had also, if I remember well, 26 already hit it once. Yes, here you see, if we go here down again to 26 again or even lower, Russia is out of the game and Iran is out of the game before even the war has started. Then we have Freeport-McMoRan. It's a copper and gold mining industry, if I remember well. Here we see also a downtrend who is broken by the upside around November 2016. And here now we reached the top of here already, what is a price around 56. And as I told you, and I will tell you a lot of times in the future, the financial markets are there to make us maximum pain, right? And so maybe the price will go down again to 3. I don't think so that it can from the mathematically momentum here, but maybe the insiders, as I told you, if they want to go long, they're gonna kick you out before they go long. And this can happen therefore here at 50. If I have a target of 55 in something like this, you know, I don't make a stop here. Why should I make a stop? For getting stopped out at 5 and then at let's say 320 there is the real bottom and it goes up again. For me that's the psychological war that the institutionals try to fight against the retailers, and they win a lot of it, but I'm not going for that. For me, if I go long here at 50 with a target of 55, my stop is 0, so I only buy the amount of Freeport-McMoRan for the amount that I want to lose in the market. So I calculate with the worst, that company goes bankrupt, and that's all the money that I put in it. If 1% is 300 euros or dollars, I only buy that stock for $300. So please bookmark all my links here. As you see now, it's saved, and then try to repeat, to take at least once a week or once a month a look at it. It takes 10 minutes, not even. You know the break-even lines. You can even print it out and compare it to the last one. You must find your way how you catch those market movements. And you have to understand, like in XHB, it's not enough to see, oh, there's a momentum who will be broken. You have to understand the ratio of real estate. If you go into a real estate ETF with gold, you have to understand how the market is rigged. You have to understand who gives the credits out, who takes the risk for the credits, who is the fucked one in that whole business. And then you can say, and how much does it cost now? How much people can buy a house? Is it still up? Is it still lower than before Lehman? All those kind of informations you have step by step to get them into your head before you commit yourself by putting money into a falling market, because that's really risky to go against institutions. If you go short into a market, you say, I don't trust anyone. I don't trust the 100,000 analysts who gain millions per year. I don't trust the Federal Reserve, who has with the smartest guys in their places. You really go anti-system, and going anti-system can hit you really, really hard. And therefore, this is not the single approach for me of shorting the real estate market of the strongest economy from the world when it comes to GDP. Therefore, keep always in mind to have an holistic approach to everything what you do. With that said, take care. Bye bye.